Ever seen gold take a nosedive and then bounce right back all in a flash? It looks like pure market panic, but it's not. What you're actually watching is a mechanical process, a predictable sequence that plays out time and time again. Let me break it down for you. When a major shock hits the financial system, the first thing that happens isn't that investors sell what they hate. They sell what they can, and gold? It's one of the most liquid assets on the planet. Think about it. Hedge funds and big portfolios are often loaded up with leverage. When a surprise hits, maybe a sudden rate hike or a spike in the dollar, brokers don't care about your long-term thesis. They want collateral, and they want it now. This triggers a cascade. It starts with crowded positioning, where everyone believes gold is a one-way bet. Then, the trigger event sparks margin calls. To meet those calls, funds are forced to sell their most liquid assets. That's why gold often gets dumped right alongside stocks. It's not because its safe haven status is broken. It's because it's a ready source of cash. This forced selling continues until the weakest hands are shaken out and the leverage is cleared from the system. So why is the rebound so important? A sharp, clean bounce back tells you the sell-off was about liquidity, not a fundamental collapse in demand. Once the forced selling stops, the underlying buyers who believe in gold's value step back in. This isn't just wishful thinking. It's the market signaling that the damage was technical, not terminal. We saw this exact pattern in 2008. During the peak of the financial crisis, gold actually dipped because everyone was scrambling for cash. But what happened next? The policy response came: bailouts, liquidity injections, and gold began its next major leg up. These drops are resets. They flush out the system and often signal that a major transition between market regimes is underway. Understanding this mechanic is key to navigating volatility. So what does a crash then rebound in gold usually signal in the present? Historically, it points to one of three regimes. Regime A is tight money dominance. The dollar is strong, real yields rise, and gold rallies struggle to sustain. Regime B is a liquidity event. Everything sells together because cash becomes the only priority. Regime C is the policy response phase. Liquidity returns, expectations shift, and gold resumes its role as a hedge against currency debasement and financial repression. The key is not guessing which regime you're in, it's watching what confirms it. Over the next 30 to 90 days, 5 signals tend to separate a dead cat bounce from a meaningful reset. First, the dollar's direction. If the dollar continues to grind higher, gold's upside is usually capped. Second, real yields and rate expectations. Gold can coexist with high nominal rates. It struggles when real rates rise and stay elevated. Third, credit stress. If spreads widen and funding markets tighten again, forced selling can return and pressure gold another time. Fourth, flows and positioning. A liquidation event often flushes speculative longs. If gold stabilizes while positioning resets, that's a constructive sign. Fifth, the second dip test. Markets often retest the lows after a violent move. If gold fails to make a new low on the retest, forming a higher low, history treats that as confirmation that leverage has been purged and stronger hands are accumulating. From here, 3 scenarios typically follow. Scenario 1. The rebound becomes a base. Gold holds above the crash low, volatility compresses, and price grinds upward as the market transitions out of the forced selling phase. Scenario 2. A retest occurs, but it becomes a higher low. This is common after liquidation events. The market tests whether selling pressure truly ended, then resumes higher once the test fails to break down. Scenario 3. The rebound fails. Gold rolls over, breaks the prior low, and confirms tight money dominance or a deeper liquidity squeeze. The practical takeaway is simple. The crash was likely the system clearing leverage. The rebound is the market asking, was that the purge or the beginning? If the next 30 to 90 days show dollar strength, rising real yields, and worsening credit stress, the rebound can fade. But if credit conditions stabilize, real yields stop rising, and gold refuses to break lower on a retest, then the pattern suggests the regime shift is underway, one where gold is not merely reacting to headlines, but front-running the next phase of the monetary cycle.